In this video, we're going to break down why you should not use the moving average, instead the Anchored VWAP and the One-Day VWAP. Here you see the 1-minute trading strategy, a result from one of our students. You can see how the market was running up. The trader was sitting down here on a computer where this violet line is. And then once the market was pushing out of this consolidation phase, you see here how the trader adjusted to $100. This would have been a $500 or $600 trade in average. Then you see how the market just runs a bit back down. And here you see another trading opportunity, $100 adjusted. So just that the trader can lose maximum around $100 in average is a $500 to $700 winning trade with the second trade, right? So we go to trading view and we're going towards here now the time zone. By the way, let me know in the comment section if you're east, if you're central, if you're west, because it's way different. We're going to place in this case central, Chicago time. And then let's just assume you're on the computer here between like 1 p.m. towards like, let's just say like 2 p.m., 3 p.m., 1 to 2 hours. I think that's pretty decent. So when you see that the market is fully in a consolidation phase, like up here, the moving average does not care that much. What the moving average cares is we put it in moving average. And then you can see here, there's the simple moving average. Here and standardized it's within 9 candles, but usually you find moving average within 150 candles, 200 candles. And what it does is it calculates the past 200 candles. And first, if you see that 200 candles went up or down, then the moving average is going to show you something significant. So for example, in this 1 minute chart, we have 60 candles within an hour. From 9 a.m., for example, like 9:07, as you can see, to like 10:07, we have 60 candles. So the moving average is not showing us anything here. It just goes flat because it means the market is not going down anymore. Now 120 candles. That's what you can see here. The moving average is still flat. And now within the next 80 candles, this is where you see now the change. This is where you see how the market now would like to go up. And that's just something what's very important is that you understand if you set this up to 150 candles, like in this case, it takes 150 candles. I mean, 60 here. 60 here is 120, and then 30 candles here. I mean, 30 minutes in this case. Your 1 minute chart is pretty simple, just like 36 in this case. And then here, now you can see that the market is literally calculating you something that the market goes up. But in that time, as you can see here, like 2 hours happened already, just that you get the info 2.5 hours that the market is going up. And the move is already almost done, as you can see here. That's also the same thing what just happened here. Just look at this one. The first time you can see that the moving average is going a bit lower. It's starting here, clearly. And the move here is also already almost done. So when you use the moving average, the problem is that you get a very delayed information for your trading. You might be only trading for 1 or 2 hours, and you need to have a solution that you can see something earlier. There are 2 solutions, by the way. The one thing is if you really insist to use the moving average, set it up to 15. If you set up the moving average to 15, it will calculate each 15 candles. If you see within 15 candles how the market goes here down 15 minutes, very often, as you can see, the market touches this moving average as retracement. You see how it goes more down, goes more back, goes above it, goes again more down because it has this short trend. This is the one thing. The better solution is to understand how to read the market using a 1 minute chart. Why the 1 minute chart? Because the moves usually take 50 minutes to 55 minutes in average, actually 45-ish minutes. And afterwards, there's a consolidation phase. That means the market is not moving properly up or down for like 30 minutes up to 5 hours. So when you understand like how to use consolidation phases, it will help you trading tremendously, especially in combination with highs or lows. So you see here that there's this high here of bigger structure. You see here's this low of bigger structure. And now we're coming something of volume. That means the volume weighted average price. This is being calculated from 0 a.m. our time. That's all right. And what you can see here is just the average price where the market is. You can see how I'm setting it up. Just like you just put the bands off, you put this background off, and then you just press OK. So now this is how the market moves. The market likes to go at a high or at a low. Once the market reached it, it does not like to go further very often. If you can see that it wants to go further, it's important for you, if you see a consolidation phase, to draw it in, and that the market is not touching the consolidation phase backwards, as you can see here. It goes up. In this case, it touches here the consolidation phase. That means it's weakness multiple times. So we cannot expect that the market is properly going higher. Once you see that the market is just like in this area, either you draw in the consolidation phase like this, or you draw it in later like this, or you draw it in like this. It doesn't matter, but you can see here the consolidation phases, and all in all, from left to right, if you first draw in this one, the second one, or the third one, the market is sticking towards it. That's also one of the main reasons if you have a moving average here where my mouse is, or like here, and it's confirming, it's just not good to trade because the market is still attached to that trading area, and usually the market will come back. So what you would like to have is something like an Anchored VWAP. An Anchored VWAP is that where you ever place this one, it will calculate between volume and price. And within the next 3 candles here, you can see it's already confirming. That does not mean that you should trade like this. It just means that it's more leading than lagging. That means it's not calculating stuff in the back like 200 candles, 50 candles, 5 candles. It will calculate what forward starting when the market is pushing out. What is really nice. That means here you can see how the market is pushing out. Place the Anchored VWAP here. We have also our confirmation here. It just makes more sense because it's more leading. It calculates from here to here. The moving average calculates also the consolidation phase in the back, what is dangerous. And the other option is if you draw on the consolidation phase, you can just see here this color switch down here. You don't need in this case the Anchored VWAP. It's just like you can see very obviously the market didn't want it to go above this high. It stood here in a consolidation phase. Usually it's not to trade there at all. Once we can see it goes in the opposite direction, it's not attached to this consolidation phase. It wants to go to smaller lows, like here, smaller low structures here. It touches it, as you can see here. And then the next one is, because this low here is too far away, the next option is the one-day VWAP. And then just repeat. The market likes to go towards a high or low. Continuous would be better, just like smashing out high, or like low. And then just like sort of in a domino effect, once the market does not have power enough, it will go in the opposite direction towards smaller in the opposite, in this case, because it was reaching this bigger structure high. Cannot go higher, is in a consolidation phase, smaller lows. And if the one-day VWAP is nearby, usually the market just likes to go to the one-day VWAP. So just to keep it simple, it would like to go to a high or low, the market. And if it cannot go there, usually it's the one-day VWAP. But sometimes the pressure is just too strong that the market cannot make it towards the one-day VWAP. So we need to have small targets in between. So here you see this color switch, and a setup is just something what you really want to have for your trading, because or else it can be that you lose like literally multiple times, what just happened here. Here you can see a trade example where our student was losing literally like 4 times, 5 times ish in a row. And here you see, by the way, because it was an open candle. A good trading platform like TradingView will show you a countdown on the right side, like it will count down within like 20 seconds or like 60 seconds in a 1-minute chart in this case. And 5 seconds before the candle closes, 2 seconds before the candle closes, with enough pressure, market pressure in one direction. It's more foreseeable. It is way more easier. It is way more consistent that when you have a green candle, that it's also going to be a green candle, that it's not just turning red out of nowhere. If we say red and green is what we use for buying, we have to see one red and green, and here's the second one, and that's it. If green red, here's the first one, and here's the second one, and that's it. But now when trading here an open candle, you can see literally that the trader here has 3 losing trades. We're just doing this properly. Entry where the red candle closes, stop placement above, being stopped out here, and the market already drove away. That's it. There's no second opportunity to be stopped out. There's no second opportunity to enter even the trade. The market just goes in the wrong direction. Very nice and clear. In cases like here in a consolidation phase, it just hit the high. The market did a higher high. You placed the stop placement where it made sense. Like the market likes to go towards highs and lows. And very often there's this domino effect. Either the market likes to go towards highs only or like lows only, what is very nice. So the other reference point is very good for our stop loss. Now, if you would use a 5-minute chart, you just have like 12 candles within an hour. And that would mean that, that you maybe have only the opportunity to adjust $10 to make maybe $20 or $30 on average, but not $50 or $80 if you just trade for 1 or 2 hours on average. Because you would like to have also the freedom behind trading, what is very important, and not just another full-time job. So here, for example, you see an example of a student, and the student was trading here. This is the calendar week with 1, 2, 3 weeks, 3 times to 4 times a week, as you can see here, sometimes even 5 times a week for 1 or 2 hours between like it's 9 a.m. Central Time to 5 p.m. This person's from Germany. And what is here important to see is that there were like 11 trading signals what the trader did not trade, and there were 9 trading signals what the trader was trading. And that's just something what's important, is to have enough trading signals if you just trade for 1 or 2 hours. Every of the signal was like, you can lose $100 or make $500. And the majorities of the signals, as you can see, were working. That means there were enough signals to go from quantity to quality. That's just something that's very important for the process, because if you trade for 4 hours or if you trade for 5 hours every day and you just have like one signal maybe every 2 days where you can adjust $10 just to make like $15, that's just not a good trading strategy. You need to have enough trading signals within your time. You need to make sure that you trade only for 1 or 2 hours, that you are high performing. It's a bit rare that somebody can perform for 4 hours consistent. It can be very tiring. And then you need also to have signals with very good money management, where you can see you can adjust like $100 to make $500 on average, or even sometimes $900, but the average would be $500, what you can actually close also. There's no sense in a trade where you can see I could have made here 8 times the amount of the trade, but then in an average you're just exiting at 50% of the trade always. So it's just not realistic to trade. In this case here, for example, there is within the second trade, as you can see, with a $100 adjustment, it could be like almost $1,500, but still exiting at $500 because of knowing when having 2 or 3 winning trades of $500, now the trader can afford like 10 to 15 losing trades, and each winning trade has the opportunity that we can afford another 5 losing trades, or even more sometimes, or like sometimes only 3 when it does not work that well. So here's an exercise for you. Make sure you have the one-day VWAP inside, that it looks clean. Make sure you always look within the 1 minute chart out of a 2-day perspective. That means that you see here 1 day and 2 days. Now you take always a picture in the beginning, and you want to have 3 things. The first thing is your trading time within a square, as you can see here. Make sure that you can really see the candles also in between a bit. Like, you don't want to see too clear, just like here. You just want to see the flow of the market. You don't want to see the wicks, the close, the open of the candle. How does the candle look like? That does not matter. It's just like when you draw in the past movement here, if you understood it at this length, make a trading plan. Draw in where do you expect the market is going at. Draw in the highs or the lows, the targets that are nearby. In this case, like this, right? So you see like the market is going up, so we don't have to draw in those targets here. We draw in those targets here because this is where the market has the highest chance of going at, because there's sort of like a magnetic function. The market is way more near towards this high than to the one-day VWAP than on this low, so it makes more sense that the market goes towards those targets. The distance between those targets are also showing you very often. You will see this in reality if you do this exercise, as I'm saying. If you take a picture in the beginning and in the end, that the market, every time there's a target like this, like 2 targets are nearby, the market is very often just getting those 2 targets within one push. Check this out on the second picture. That means we take a picture in the beginning, we were drawing in the past 1 or 2 hours, we were putting front like a square just as a reference point, what to expect for kind of movement based on the past movement. And then we also were drawing into targets within what is just realistic in our trading time. Now check this out. You can see here, the market really made that move. And in combination, you can see here 2 targets together here, 2 targets are together here. And within 1 minute candle, the market was able to pull that out and then retraces and then goes towards the other targets. And every time you see like this distance, like from here to here, there's a big distance. This is like breaking down the market, its momentum. Every time you see there's a distance, like for example, here you have 3 targets that are close by. Here's this distance, and here again, 2 targets that are nearby. And this is one of the main reasons why the market was turning here. It's hard to see it live, but it's possible to foresee it first within 4 trades. That means like if you take a picture in the beginning and you draw the targets in and you understood this, and then you are looking at this live while the market is touching these targets, how the market is touching those targets, how the market is reacting there. Is it still doing a lot of green candles? Is the market doing nice retracements and then continues in going in that direction? And then you do a picture after 1 or 2 hours of trading time in the same perspective, as you can see here, picture 1, picture 2, picture 1, picture 2. Then you will be able to see what the market actually does, and you will see days where it's more easier for you to see, more clearer. It will have more common sense that the market would like to go towards this high, like in this case, than towards straight to the one-day VWAP, or like towards the smaller lows first, because you see how aggressive the market was pushing up in one direction. You will see how far away the targets are. This is something that's very important. You have to prioritize targets. If they're more near to the current market, you have to prioritize on what kind of length did the market do the past 1 or 2 hours. For a lot of trading opportunities, that means like if you sit down for 1 or 2 hours in average and you want to have like 30 to 50-ish signals where you can see you can put in $100 on average and make with that like $500, there will be a lot of trading signals where you literally can let the market run in one direction for 30 minutes or even longer and then hop on that trend. And this is one of the main reasons why the 1 minute chart can help you to become a better trader, and in combination with this routine, what I just gave to you with taking a picture in the beginning and then doing a picture in the end, and of course with notes, like where did you expect the market is going.